Good morning, traders. This is your Forex market commentary brought to you by REAL ECN. Today's commentary will encompass the Euro-Dollar market. The Euro-Dollar multi-week decline is forcing the pair to trade at a key inflection point, which formed the support of the rising wedge formation. A sluggish Eurozone CPI growth coupled with disappointing GDP print has shifted the fundamental outlook on the single currency to bearish, as the market expects aggressive easing policy during the next ECB meeting. I hope that this commentary will prove to be insightful for everybody in formulating a successful trading strategy. So first, in line with this discussion, we're going to break down the Euro-Dollar market on a technical front. The narrative for the Euro-Dollar price action indicated that the single currency has declined significantly against the greenback to its lowest point this month over yesterday's trading session, shy of the 1.3650 zone. On a larger time scale, the pair is trading slightly above the support floor of the multi-month ascending channel, which is established at the 1.3673 level set at 61.8% Fibonacci retracement. If momentum failed to pick up and price action break below the support level of this rising wedge formation, this will expose the pair to the 1.3598 level set at 76.4% retracement. Before taking on short Euro positions at this level, one must consider its risk and reward profile against the backdrop of long-term fundamental outlook on the pair. In accordance with the SSI, which is commonly known as the Speculative Sentiment Index, net retail traders' short positions on the single currency is very reflective of the prevailing price action trading, as the pair is trading near its support level. Retail net short positions and interest on the euro has leveled off significantly, currently sitting at 1.5 net short position for every one long position taken up by retail traders against the greenback. Long euro interest is beginning to show sign of gaining traction. Analysts also believe that in taking the contrarian standpoint to this extreme crowd sentiment, it is in favor of further euro decline. Analysts are also calling for a further decline in the euro with the lower extent of this near-term decline set at 1.3294 under the condition that the single currency failed to sustain trading momentum above the trend line. Analysis of a collection of technical indicators on the hourly interval on the Euro-Dollar market suggests a temporary bullish market sentiment and recommend long positions on the euro. The hourly chart showed that the single currency opened today's Sydney trading session 1 pip below its established short-term Fibonacci resistance at 1.3714, while the Fibonacci support is set at 1.3708. Last week's euro correction has forced the euro-dollar cross to break below the 200-day simple moving average and continue to trade below the 200-day simple moving average. The long-term outlook on the single currency has been downgraded to bearish if this trend line continues to trade below the 200 days. This trend action holds great significance as it contains more or less 1 year's worth of trading data and it forecasts long-term market sentiment. However, this bearish long-term outlook on the euro-dollar pair is not shared by its short-term moving average counterparts, as the euro-dollar pair opened today's Sydney trading session below the 5 but above the 10 and 20-day simple moving average. Collectively, this is indicative of a buy recommendation on the technical front. Also validating this bullish standpoint is the RSI, which indicated that based on the intraday price action of the pair, the bullish momentum has gained traction substantially, trading above the 55.00 price value in the bullish territory. Moving on to the fundamental front on the euro-dollar market. The euro-dollar pair opened today's Sydney trading session after rebounding from yesterday's trading session's low set at 1.3650 and back into the congestive trading range north of 1.3700 level. This week's risk event surely has not worked in favor of the euro. On Tuesday, the ZEW Economic Sentiment Index came in lower than expectation by ticking at 55.2 when forecast expects a 63.5 reading. In addition to that, the German ZEW Economic Sentiment Index fell below expectation by ticking in at 33.1 when forecast was set at 41.0. During yesterday's trading session, the only optimistic news feed giving support to the single currency was the German GDP year-on-year print, expanding at 2.5% above the expectation of a 2.2% reading, coupled with the GDP quarter-on-quarter growing by 0.8% when forecast was at 0.7%. However, the Eurozone as a whole failed to meet expectation, with GDP growing at 0.9%, less than forecast of a 1.1% reading year-on-year, while quarter-on-quarter Eurozone GDP reading came in at 0.2% when forecast was set at 0.4%. The overall picture of the recent Eurozone leading economic indicators now support the argument that the ECB will aggressively implement easing policy during the June meeting. These easing policy may come in the form of the bank cutting deposit rate down to minus 25 basis points, with the intention to force banks to lend more and hope that money velocity will pick up. In addition to that, benchmark rate will be cut down to 15 basis points. Being that the Eurozone CPI number continued to remain sluggish at 0.7%, well below the ECB CPI target 2%, the conditions are set for an aggressive easing by the ECB during the June meeting. Across the Atlantic in the United States, despite the improvement in U.S. leading economic indicators, the market has been somewhat muted and non-responsive to the underside of the greenback. Long-term U.S. Treasury yield continued to remain under pressure below 2.5%. During yesterday's trading session, the Philadelphia manufacturing activity appeared to have picked up, coupled with the core CPI print month-on-month beating expectation by ticking at 0.2% when forecast is set at 0.1%. However, these upbeat and leading economic indicators failed to lift the yield on the U.S. Treasury, as the market has little confidence in the long-term sustainability of these indicators. Therefore, they don't believe that this week's upbeat economic reports can sway the Fed's undertone from keeping interest rate low for an extended period of time. I want to thank all our listeners for spending the time with us, and have a successful trading session, everybody.